Welcome to Qualified Opinions, where we test the ideas and limits, the knowns and known unknowns around freedom and order in contemporary politics and society. We invite you to listen as we engage with leading and emerging thinkers across disciplines and issues who will sharpen our thinking on the topics shaping our discourse. Welcome back. With some provisions of the 2017 tax cuts set to expire in 2025, legislators are scrambling to find ways to fund their extension. It's an effort that could cost over $4 trillion. Add in President Trump's demand for a no tax on tip and a 15% corporate income tax rate, and you're left with a stiff bill and still only one vote majority in the House. It's in this context that the House Budget Committee Republicans have drafted a 21-page reconciliation proposal covering tax and spending change across 11 committees. These changes are offered as potential trade-offs to pay for the tax extension. One option prompted me to reach out to Cato Institute's Director of Fiscal Studies, my friend Michel. That option is the border adjustment tax. It's a proposal we spent months fighting against back in 2017. So what exactly is a border adjustment tax? How does it work? Why is it controversial? And what would it mean if the U.S. adopted it? Better yet, we're going to talk also about what we would prefer to see and how Congress can go about doing the right thing. Welcome, Adam.
Thanks for having me back on.
So we all were surprised and I think happy to see this list from the House Budget Committee of all the possible trade-offs and different offsets to pay for the extension of the 2017 Trump tax cuts. Wouldn't you agree? I mean, we like that they went through that exercise.
Yeah, the exercise of being aggressive in both putting together a list of spending cuts and tax expenditure reforms, pairing with there's also some tax cuts on the list, I think is a really great sign that Republicans are serious about the reforms that they're going to be pursuing this year, and sort of doing the hard foundational work of what are all the things that should be on the table.
As a way of background, I think it's worth kind of reminding listeners what's the context for all of this is. So some provision of the Trump tax cuts, I mean, as their shorthand will say, all of the individual provisions and full expensing are going to expire at the end, most of them at the end of 2025. Extending them is going to be scored as a deficit riser. In order to be able to use reconciliation, they're going to have to have no deficit 10 years out. And they're right now debating how much they will agree to have as a deficit figure for the 10-year window, right? So that's kind of broadly the setting for this. There's some projections that extending the tax cuts would cost between $4 and $5 trillion. And because of the pressure on the deficits and some deficit hawks in the House of Representatives, they're going to try to lower that number of how much the deficit would be allowed to grow for extending the tax cuts. And it's in that context, I think, unless you correct me, that Chairman Harrington put this list of different ways to pay for the extension of the tax cuts.
Yeah, I think that's certainly one of the dynamics that's going on in this debate. The other thing is I think many Republicans, especially in the House, are truly committed to shrinking the size and scope of government. So whatever you think about whether or not the tax cuts should be extended with other offsets or not, if you want to just right size the size of the federal government, of course you should be pairing any sort of tax cuts or tax permanency with spending reforms. That's really the only way in the long run to ensure taxes don't have to go up at some point in the future. So whether or not you think that tax cuts need to quote unquote be paid for, or you just want to right size the size of the federal government, this list sort of gets to both of those constituencies.
Yeah. So the reason why we're having this podcast on the border adjustment tax is that on that list of offsets for the extension of the tax cuts was a border adjustment tax. And there were also tariffs and a bunch of other things. So my first question to you is, what is a border adjustment tax, and how does it work in practice?
Because I think it's important to maybe start first with the theory. Like, why would someone propose a tax like this?
Yeah.
And it's, as you said, it's instructive that it's on the same list as tariffs as a possible revenue raiser. But the border adjustment is usually paired with a cash flow tax. It's called a destination-based cash flow tax. And cash flow taxes are relatively uncontroversial. It just allows businesses to fully deduct all of their expenses before paying taxes. But adding a border... Including capital. Correct. Wages, capital. This has full expensing is sort of key piece in a cash flow tax. But adding a border adjustment to a cash flow tax, making it destination-based, is incredibly controversial. And basically
and unproven.
And unproven in the context of a corporate income tax, correct? Mm-hmm. And so the border adjustment, what it does is it simply tries to remove the tax from exports and impose it on imports. So it gives exporting firms a deduction for the exports they're doing, and it levies the corporate income tax on imports by importing firms. And so this border adjustment feature is intended to remove the corporate income tax from products sold abroad. But there's a lot of really strong assumptions underlying this tax that ultimately makes it very unlikely to sort of meet the goals that some proponents claim that it will have.
So the reason why we're also having this conversation is because in 2016, when it was, or 2017, when it was first talked about, during the discussion about the Trump tax cuts of 2017, which ended up being the Trump tax cut of 2017, you and I were very, very active fighting the border adjustment tax. And I remember at the time you were at Mercatus, and I came to see you, and I was like, "Did you see this? It's completely crazy." And because you're much more calm than me, you said something to the extent that you'd have to look into this. But I was just very, very exercised just by the whole kind of structure, like the border adjustment. I hate like the what felt like penalizing imports and favoring export. Anyway, it just like my gut feeling was, and I was very alarmed by this tax. And in the end, I think we were right to be alarmed. And so now there is a chance that it could be part of the conversation again. So why was this tax considered in 2016, to the best of your knowledge, and ultimately, why was it rejected? Can you do a little history on this?
Yeah, so back in 2016, this proposal was included, I think, because for sort of two reasons. One, because they were trying to pursue a revenue neutral tax reform that needed additional revenue in order to pay for steep reductions in the corporate income tax and other tax cuts. But there was also this theory that a border adjustment was sort of economically efficient, and that imposing this tax on imports and removing the tax from exports would be nullified by an appreciation of the US dollar. So this appreciation of the US dollar, if you have a 21% tax rate, would require the US dollar to appreciate by about 27% to offset this new border adjustment tax. Ultimately, this idea was rejected in the 2016 and then 2017 tax debate because it became clear that the theory, when met with reality, didn't actually hold up.
So how can we test, for instance, the theory that if you impose a border adjusted tax, then currency adjust, hence removing the penalty against import and the benefits of exports?
Well, so there's a couple different ways to answer that question. I think one is looking at who was sort of for and against this tax change in 2016. And the sort of export heavy firms supported the idea because they thought they were going to get a subsidy, and importers opposed it because they thought that this was going to be a massive new tax bill on them. They were claiming at the time that their tax bill could be up to 5 times their profits because they didn't believe that currencies were going to fully adjust. You can also look to similar mechanisms that are imposed on value-added tax around the world, and when we've imposed tariffs in the past. And in each of these instances, it's pretty clear that currencies don't adjust fully or as quickly as the economic theory would suggest, which ultimately erodes the case that this tax would be sort of nullified by the sort of broader currency changes, and then ultimately would look something more like a tariff rather than a sort of neutral addition to the corporate income tax.
And for those interested in this geeky question of whether a currency adjusts when you have a border adjusted tax, Stan Verger at AIER at the time, I think it was in 2017, wrote for the Mercatus Center a paper that actually looked at the literature on this particular topic and finds that it's really wishful thinking, this idea that currency will adjust quickly so that there won't be an enormous cost to pay. But you've said an important word, tariff. One of the arguments that we hear a lot among the people who are hoping to renew the debate around the border adjustment tax is this notion that somehow it may be a way for the protectionist and President Trump in particular to impose tariffs without actually imposing tariff and to impose basically a protectionist measure in a much less distortive way. What do you think of that idea?
Well, I think it's telling that there's really 2 different camps of advocacy for the tax. One is claiming that it is most certainly not a tariff and is not distortionary at all. And the other camp is claiming that this acts like a tariff and gives Trump the tariff-like mechanism that he's looking for. And so on its face, both can't be true. It's going to be sort of one or the other. And in my view, because I don't think that currencies will fully adjust and the tax won't ultimately be implemented in sort of the broadest way that it would need to for the theory to work, that we're going to end up with something that looks more like a tariff,
and like a broad-based tariff.
A broad-based tariff, and comes with all of the costs that you would associate with the sort of Trump universal tariff plan. And so in that sense, it should be discarded as a highly inefficient source of new revenue that would ultimately erode a lot of the benefits that we would hope to see from a lower corporate income tax or full expensing or any of the other sort of pro-growth additions to tax reform.
You wrote a piece at your Substack, which I recommend to everyone, called "Reviewing the Case Against a Border Adjustment Tax," where you dug up a quote from Peter Navarro, who is the Trump's director of the White House National Trade Council, from the Heritage Project 2025. And he said, I actually hadn't read this, that the border adjustment tax is an innovative alternative to the application of tariffs. And so that kind of it's interesting to me because this is from a guy who loves tariffs, right? And who is just basically admitting that this is what it would do. But I do wonder though, President Trump likes the ability to impose tariffs on whatever he wants for whatever reason it wants. We just saw it with Colombia, right? For complete things that have nothing to do with trade. I mean, and so I just don't see how he'll be able to go back to his base and say, hey, I'm not doing tariffs, but I'm doing a border adjustment tax. And I mean, it just doesn't seem right.
I think that's exactly right. I think the argument that you can do this bait and switch with Trump and give him a border adjustment and all of a sudden he won't want to do tariffs anymore is really wishful thinking. You're right. I think for Trump, tariffs are maybe rhetorically about raising revenue, but they're more importantly about sort of his negotiation tactics, the ability to sort of come in and slam people with high tariff rates and maybe and sort of get things out of negotiations. I don't think that that's a good strategy, but that's how he sees them. And then also as a form of industrial policy, he wants to be choosing favorite industries, one or this one over that one, and helping incentivize where companies do production around the world. And border adjustment doesn't allow him to do either one of those main things he's looking for in the tariff tool. And if he were to try to use a border adjustment in this way, it would make it even more inefficient and make it more likely to have high economic costs. And so I just think that this whole argument that Trump can be hoodwinked into doing something that is more economically efficient is ultimately far-fetched.
Which reminds me that, I mean, he killed the border adjustment tax already back in 2017. He said he's the one ultimately who said, yeah, we're not doing this, right? So is there any indication of where he is on this?
I haven't seen anything from him directly that he's either for or against it this time around. Trump is sort of famously fickle on these things. So who knows where he is, what he thinks about it today. But certainly it was taken out of what ultimately became the Trump tax cuts in 2017 because it was a big political problem. The business community was divided on it. It divided the sort of conservative tax reform coalition, and I think ultimately economists were divided on this pretty deeply as to whether how would this novel mechanism actually impact markets, and there was sort of a big question mark there at the end.
I also have a feeling that the border adjustment tax could get in the way of his objective to bring more companies here into the U.S. Because if I understand the tax properly, each time you bring something, whether it's an input for production in the U.S., you get hit by it, right? So, for instance, like let's say you're a car company. I mean, a car company. There's enormous related trade between whatever the car company in the U.S. and abroad, right? They send stuff to each other. How would that work? I mean, I have a feeling that it would probably be making things more difficult considering the global supply chain we have.
It certainly will create new frictions in trade, and this is especially if the tax isn't fully implemented in a way that is neutral across importers and exporters. If you're a firm that's based in the United States and you're primarily an exporter, the federal government would, in sort of an ideal world, ideal in scare quotes, would have to actually be sending that company checks. They would be facing a negative income tax over the lifetime of their firm if they're primarily exporting because of this export subsidy feature of the border adjustment. And in no real world is the federal government going to be sending large exporters like Boeing and GE checks every year in order to make this tax more efficient. So you then have to set up these complicated systems of net operating losses that might have to create a trading system that will be inefficient in a bunch of ways. And all of those dynamics mean that the tax will be quite distortionary and treating importers and exporters very different, and ultimately undermining a lot of the efficiency arguments that some people make about these taxes.
So why do you think we're hearing about the bat again this time around? what's the dynamic? Because it seems again that the people who are pushing for the border adjustment tax this time around are not people who were pushing for the border adjustment tax last time around. Last time around, it divided the free market coalition, tax coalition, because people wanted, didn't want a new tax. But this time, it's really the coalition of those who would want the bat are the protectionists, or those who think they can fool Trump into giving up tariffs, and those who think it's a more efficient tax. So I just I'm wondering how that works.
Yeah, so I think the two main reasons why it's coming back this time are the first one you identified, and that some people are desperate to find something other than tariffs to give Trump, because they feel like they have to give him something that looks like tariffs, and they're searching for something, and this is the something that's lying around. They're, as we discussed, they're ultimately, I think, mistaken that you can do this bait and switch, but that's the logic behind where this proposal comes from. But under the surface, I think there's a second motivation, and that's Trump has sort of famously, from his first term, not been an aggressive cutter of the size and scope of government. Trump likes to spend money, and he's ultimately reticent to scale back what the things the government is spending money on. And so, without spending cuts, you have to find new sources of revenue. And this is a massive source of new revenue, more than $1 trillion over 10 years. And so the tax both helps make the numbers work without forcing Republicans to actually cut the size of government, and also scratches this protectionist itch that is sort of becoming more popular in Republican circles.
So it seems it would make producing in the U.S. more expensive, right? I mean, if currencies don't adjust, right, fully, or I mean, it would certainly make producing in the U.S. more expensive. I mean, that said, I mean, tariffs do that too, and President Trump, for all his talk about bringing prices down, don't seem to believe that, but it would make prices more expensive, which explains why the first time around there were so many companies. So can you think of like one good reason to adopt such a tax? Because I mean, it's a big lift to really move to a totally different tax system.
Yeah, this was the beyond the problems with the sort of economics underlying the tax. One of the other main arguments behind sort of why you wouldn't want to adopt a new tax like this is that Republicans should certainly not be the party that's going to add the sort of largest new tax to the federal system since the adoption of the income tax. This is ultimately adding a new source of revenue to the federal government that will likely just drive continued government growth over time, like the value-added tax has done in the European Union. And this is sort of the political economy reason why small government conservatives, people that favor sort of limited federal government, should be against this adoption of a novel revenue stream. Instead, we should be focusing on reforming the existing tax code we have and cutting government spending.
So it would replace the corporate income tax?
It would be a significant reform to the corporate income tax. I think this border adjustment mechanism really should be thought of as a new revenue stream rather than sort of just a replacement of the existing corporate income tax, because it raises so much additional revenue.
Yeah. And so is there a risk under this system that you open the door for a traditional corporate income tax to come back?
I think the bigger risk is that the tax is turned into a value-added tax in the United States, which really just, once you have the the border adjustment feature, if you just start limiting or slowly denying the wage deduction to businesses, you more or less have a value added tax in the United States, which for has a long time has been a major, the free market small government coalition has been very opposed to the adoption of a brand new source of revenue like a value added tax, because it is associated with fueling the growth of government sort of everywhere it's been added.
Yeah, and European countries have both a value-added tax and a corporate income tax. So,
correct, and an income tax and a payroll tax, and this sort of layering of new taxes, one on top of the other, is the reason why the European welfare states have been able to grow so much larger than than it is here in the United States.
In your Substack, you talked about how this could be a major transfer of wealth from the American people in other countries, right? Can you explain how would that work?
So in the assumption that the currencies adjust, even if they don't adjust fully, but it's, say you take the advocates of the tax on face that currencies are going to appreciate by almost 30%. Many Americans, including in pension funds and in other investment accounts, have holdings overseas that are denominated in foreign currencies. And when the U.S. dollar appreciates in sort of one go, that erodes the value of those holdings around the world. By one estimate, Americans' wealth would decline by about $8,000 per person. Another study found that it would be equivalent to about 20% of U.S. GDP. And so this would be effectively a massive wealth transfer from the United States to people living outside of the United States. And this is just one more of the strong assumptions that's required to make this tax work on the blackboard. And that's that wealth is evenly distributed and denominated in sort of equal assets and liabilities are equally denominated so that they cancel out across borders. And that assumption just simply doesn't hold true in the real world.
And of course, I mean, if there is really such a transfer from America to outside of America, that should be kind of a red flag for President Trump, who claims that he believes in America first.
Yes, it certainly would go cut against that narrative, sort of with a sudden appreciation of the dollar, making Americans poorer sort of overnight. Is I think would certainly not be a good thing or fit the president's narrative.
Do you remember in the House budget document, do you remember how much money they think they could raise from the border adjustment tax?
I think they said over $1 trillion over 10 years, maybe 1.2, but it was an approximate value.
And that's kind of to go back to the point that you were making before. I mean, it's kind of a shocking development for Republicans to be actually trying to pay for extension of tax cuts that most people expected would be extended with a new tax and a new source of revenue.
Yeah, it's certainly the seeing a border adjustment there with universal tariff proposals as pay-fors for tax cuts, I think is concerning. That said, there was lots of very good proposals in the document, and it's, I think, ultimately supposed to just be a menu. And so the broader project of putting together all of these ideas, I think, is still a very good one and one that I'm supportive of. But we should take the opportunity to talk about the ways that we shouldn't be raising new forms of revenue, and that's these tariff-like mechanisms, either in name or similarity.
Yeah, and that's what we're doing. I think we're really taping this because precisely we want to remind people why it's such a bad idea. Now, on the good news front, I think kind of you and I, we do think that it is a long shot, right? It's a long. I mean, can you tell me how you were thinking about it?
I mean, I think ultimately the Republicans have a very narrow margin in the House, and they're not going to be able to adopt anything that splits the conference. This includes the adoption of broad-based tariffs, I think are unlikely to be included in a final package. And I would fit the border adjustment tariff-like mechanism in that same bucket, that ultimately coming to consensus around the tax package is going to be difficult enough. Adding these types of incredibly controversial, sort of economically risky, speculative economic projects into the bill makes it all that much more challenging. So hopefully that provides some protection from the worst of these ideas being included, but we should certainly still use it as an opportunity, as we are, to sort of review this debate that we had in 2016 and 2017 that then also resulted in the tax being pulled out of the package because it was so controversial.
Yeah. And so let's talk about the extension of the tax cuts and what we'd like to see instead of a something paid for by the border adjustment tax. So let's see. What would you think would be your priority taxes to provisions that you would like to see extended for sure?
So the taxes that are expiring are individual tax cuts, reforms to the individual tax code, like the larger child tax credit, and repealing some personal independent exemptions and other simplifications. And then business tax changes like full business expensing, which is an incentive for businesses to invest here in the United States, being the primary driver of the economic growth that we would expect to see out of the package. So I would like to see Congress focus on making the most pro-growth pieces permanent, and that's making full business expensing permanent, expanding it further if they are able, and then focusing on making the individual side permanent first, and focusing on sort of certainty by making top income tax rates permanent and some of the simplifications permanent. But that should all be paired with continued reforms to the tax base, which was the foundation of the 2017 reform.
So you've said make the taxes permanent. So last time around, the only thing that was made permanent was the reduction of the corporate income tax rate from 35%, which was the highest or the second highest of all the OECD countries, to 21%.
It was the highest in the developed world.
Yeah. And so why is it so important, in your opinion, to make these tax cuts permanent?
Yeah, the 2017 tax cuts were primarily pro growth because the corporate income tax cut was permanent. Some of the growth came from the business expensing, but most of the growth came from the permanent feature of the reform, the lower corporate tax rate. And that's because it was the corporate tax cut, but also because it was permanent. And businesses need certainty to plan their investments and make decisions over the long haul. And without permanent tax changes, all you're doing is changing the timing of business decisions and not the total amount of business investment that you're expected to see. So if you can make these reforms permanent, then you should expect to see additional economic gains because individuals and businesses can plan for that have that certainty that the tax regime is going to stay the way that Congress set it, rather than it sort of snapping back every couple of years and making that long-term planning more difficult.
Well, especially the full expensing. Can you explain what full expensing is and why? I mean, you and I agree on this. Why we think it's so important?
So under the normal income tax system, businesses have to deduct the cost of new investments they make over time. And the IRS makes up what they call depreciation schedules, which tells businesses how long they have to deduct an asset over. So
and these schedules depend on what business it is, what kind of asset it is.
What kind of asset is, how long the government thinks something is going to last, more or less. They're really bad at actually aligning these two things, but that's the theory behind it. And so if I make $100 investment in a new piece of equipment, but but it takes me 10, I can deduct the cost of that investment over 10 years. That deduction in the 10th year is a lot less valuable to me today or in 10 years than it would be today.
Is it adjusted for inflation? I mean,
they're not adjusted for inflation. So that's the problem. Is inflation in time erodes the value of those deductions to the business, which ultimately raises the cost of making the investment because the investment has to return a higher profit to cover the losses of inflation in time as that deduction becomes less valuable.
And there's also, it creates a disparity between labor and the way the tax code treats labor versus capital, right?
Yeah, business gets to write off what they pay their workers in wages when they pay the wages. And when investment is not treated like this, they cannot deduct the cost immediately, but instead have to carry those deductions forward. And so full expensing just says we're going to treat an investment in a new piece of machinery just like the wages you pay to your employees, that you get to deduct that in the year that you make it, allowing the business to fully recover the value of those deductions and making it easier, more likely lowering the effective tax rate on new investment. And just to sort of step back, new investment is a sort of seed of long-term economic growth. Workers need better machines, newer machines, new tools to work with to be more productive, to then claim a higher wage. And so we should expect to see workers working with more investment from businesses after investment, commanding higher wages, seeing more job opportunities. And that's the sort of story of pro-growth tax reform.
Yeah. So I was going to ask you, what's the literature saying on the impact on growth of moving, let's say, permanently towards full expensing?
So expensing is, for sort of per dollar of reduced revenue, the most pro-growth reform, pro-growth thing you can do in these tax reform packages.
More than the corporate income tax?
More than the corporate income tax. Because it is a forward-looking reform. It is allowing deductions for all sort of future investments, where lowering the corporate tax does that for future investments, but also is an effective tax cut on investments that were already made. So per dollar of lower revenue, you're getting more sort of economic bang for your buck with the full deduction, full expensing deductions. And so this is the 2017 reforms allowed these deductions for things that last less than 20 years. This is equipment and tools. And so one of the most powerful additions Republicans could make to the tax reform this time around is expanding this expensing treatment to structures. So you can write off the full cost of the sort of manufacturing facility that goes around all the tools and equipment you're buying. And we should expect that to be an incredibly pro-growth addition to a package that is otherwise sort of not nearly as pro-growth as what was passed in 2017.
And in part, I assume, because people were already expecting that these tax cuts were going to be extended. So it's not as pro-growth.
That's part of it, but in the sort of broader sort of economic models that assess these things, the big difference is that it doesn't include the reduction in the corporate tax rate this time.
That's true.
Because that was permanent.
Yeah.
And so that's why if Republicans want to talk about this 2025 tax package as being a pro-growth tax package, they'll need to include some of these other additional pro-growth features in addition to the sort of individual tax cuts, which are important in letting Americans keep more of their own paycheck, but tend to be less sort of pro-growth per dollar of lost revenue than some of these other changes.
And it was really unfortunate. I mean, the full expensing, considering how much of a machine for growth it is, not only, actually, it's not just good for growth. It's just basically the right thing to do. It's the best form of tax reform that you can think about. And unfortunately, they treated it as a more temporary tax cut or tax reform than they did the reduction in the marginal tax rates for individuals, because they started phasing out in 2023, right? And the phase out, this gradual phase out, I assume it's kind of, I mean, it's punishing. It's not great, right? Because while it's still better than the alternative, I mean, they know that it's decreasing over time, and it's going to be phased out entirely in 2027, right?
At the end of 2026, it fully goes away. You're right. I think the gradual phase out, it actually made it easier for Congress to not renew these provisions, because it sort of ramped down more slowly. And it started several years ago, where at the end of 2025, the individual tax cuts all snap back immediately, and that's the forcing mechanism. And so we've had these several years where expensing has been being pared back incrementally, and we're going to have to wait until the end of this year for hopefully these deductions to be fully renewed. But if they're not, that would be would make the tax package even less sort of growth oriented than Republicans are talking about it.
Can you make the case that moving to full expensive in a permanent fashion is actually the most effective way for President Trump to get what he wants in terms of favoring at-home manufacturing?
Yeah, those full expensing deductions are for an investment that's made in the United States. So, and it's not favoring investment in the United States. It's just removing the existing tax penalty on the existing tax penalty on investment in the United States. So it's actually creating a neutral investment environment in the United States. But it still will help facilitate any businesses that want to bring manufacturing or any other sort of investment back to the United States. It will make the United States, paired with lower corporate tax rates and his deregulatory agenda, will make America an even more attractive place to do business compared to all of the places around the world. And the sort of only thing that could undermine that is if he also is imposing large counteracting tariffs or a border adjustment or something else like that.
Yeah, and he's been talking about reducing the corporate income tax rate to 15%, which is the right thing to do, except that the way he wants to do it is it's 15% for those who produce in the U.S. and it's 21% for the others. And it seems to me that it's kind of misguided, these double treatment. You should just actually go down to 15%. That seems like a no-brainer. And I mean, I guess it is everything that has to go through Congress requires a lot of brains, and then moving to full expensing, and he would get a much better tax code with fewer exemptions and just a much more, more beautiful code, basically less complexity and certainly like just a treatment of manufacturing and a treatment of building and producing growth that would it be rivaled around the world? What are the other countries that do that better?
So the 2017 tax cut lowered the United States corporate income tax to about the middle of the pack when you look at other sort of OECD countries, we're still slightly above average. So cutting the corporate tax rate to 15%, the federal corporate tax rate to 15%, when you add in average state rates, would give the United States corporate income tax in the bottom third of sort of countries around the world, which would make us incredibly competitive when you add in all of our other sort of economic advantages. And so you're right. Reducing the corporate income tax to 15 would be incredibly pro-growth. It would be a great addition to the tax package. and it's unclear what exactly Trump means when he wants to lower the rate just for businesses that make things here.
Didn't we have a tax credit like that before?
His 2017 tax reform repealed the domestic production activities deduction, which was which could be described as a policy that cut the tax rate for businesses that made things here. And it was repealed in Trump's tax cut because it was widely understood as ineffective and not easy to target to manufacturing and the things that Trump would otherwise want to target to. And so instead, my sort of call to Trump is to look at the success of the sort of Ireland's model of just simply lowering the corporate tax rate as low as possible, and that in and of itself attracts businesses, business investment, physical jobs, and physical investment to the United States in a way that gets at what he's looking to do, but in a more sort of neutral way that treats everyone similarly.
Is Ireland still at 12.5% or 12%?
12.5%.
Yeah. Yeah. And what do they have? Do you know if they have full expensing?
I don't know what their cost recovery rules are, but their rate is so low that is, and they have other business friendly policies that paired together make them an incredibly attractive place to do business, especially compared to all the higher tax countries across the water in Europe. And so they have this competitive advantage in sort of where they're situated as well.
What about what's your take on the growth factor behind cutting the individual tax rates, or actually just extending them, or even actually cutting them further?
So what we should expect from cutting marginal tax rates for individuals is that people will work a little bit more than they otherwise would. If you can keep more of your earnings, there's an incentive to work a little bit more. And this is the primary channel through which we should expect to see additional growth. And you do see that when you model these reforms, it is mildly pro-growth, but if sort of for your bang for your buck, how much the sort of lost revenue you get per additional economic growth is lower than some of these other reforms. And that's why I'm a big fan of cutting taxes for individuals. I think people should be able to keep as much of their hard-earned money as possible, but those need to be paired with spending cuts, because we can't keep spending significantly more than we're willing to raise in tax revenue. And that's sort of where the other side of the budget has to be part of the conversation. And
marginal tax rates reduction are far, far superior to tax credits and things like this as a means to letting people keep more of their money.
Yeah, and this is one of my concerns with some of Trump's proposals, like no tax on tips and no tax on overtime and no tax on Social Security. These are all targeted tax cuts that only will benefit a select few of Americans. Like I'm not sure the rationale for why you want to cut taxes for someone that's waiting tables instead of a firefighter or a teacher or someone that doesn't get tipped wages. I think a much better policy would be to cut tax rates for everyone across the board, if the goal is to indeed let people keep more of their hard-earned money, rather than singling out specific constituencies with these sort of targeted, distortionary exemptions and deductions.
Well, I guess that's all the time we have for today, but thanks so much. And I hope we're recording this episode for no good reason, and that actually there's no momentum behind the border adjustment tax, which to me, really, to sum it up, is a terrible way to do tax policy, one that imposed basically a broad-based protectionist measure, expecting enormous, like crossing your fingers in hope that you're going to get enormous adjustment of exchange rates, but also something that has the potential not just to actually impose way more taxes and raise way more revenue, which then often fuels spending, but also could eventually lead us to get maybe a value-added tax and bring back the corporate income tax and basically look just like the Europeans. So I kind of I hope we tape this, for no good reason, and that just is just a threat and of something we don't have to worry about really in the end. So thanks, Adam, and I will continue cheering on for lower and lower corporate income tax. Actually, why wait why go to 15% when we could go to 12%? In fact, that's what the Cato plan is saying, right?
Yes, the Cato tax reform plan calls for a 12% rate. And it says the ideal rate is 0, but within the constraints of current levels of spending and trying to do a revenue neutral tax reform plan, you can get it to 12% if you repeal enough special deductions, credits, and loopholes. And I think the point that you make about the sort of where tax rates could be in the future if you impose something like a border adjustment is exactly the right way to be thinking about this. One of the reasons supporters like a border adjustment is they see it as protecting the United States from tax competition with other countries around the world. And if it wasn't for this force of tax competition, we would still have corporate income tax rates that are 50% or higher. And so this is the sort of yet another reason why these sort of protectionist measures that are supposed to protect the United States from competition elsewhere in the world could ultimately backfire, making all of us worse off with higher tax rates in the future.
Well, let's hope that we prevail again. Bye, Adam.
Thanks for having me on.
You're welcome.